The stock market is falling. The news is terrifying. And everyone is asking the same question. Should I buy now or wait? In this video, I'll show you a simple checklist you can use before buying any stock. No secret signals, no guaranteed winners, and no pretending that anyone can predict the future. Step 1. Know why you want to buy. Before looking at the ticker symbol, ask yourself what you are trying to achieve. Are you investing for long-term growth, dividend income, or a short-term trade? These are different strategies. A stock that may be interesting for a 10-year investment may be completely unsuitable for a short-term trade. Your time horizon matters because stocks can fall sharply in the short term. If you need the money soon, you may not have enough time to wait for a recovery. Step 2. Understand the business. If you cannot explain how the company makes money, you probably should not buy it yet. Ask, what does the company sell? Who are its customers? How does it make revenue? What makes it different from competitors? What could seriously damage the business? Do not buy a company only because its chart is rising or because someone online says it will explode. Step 3. Check the numbers. Look at revenue, profit, cash flow, and debt. A company can be popular and still lose money. Another company can have strong sales but too much debt. Numbers do not tell you everything, but they can reveal problems hidden behind an exciting story. Also remember that a great company can still be a bad investment if the price already assumes unrealistic growth. Step 4. Think about valuation. Price matters. A stock may be expensive compared with its earnings, sales, cash flow, or the growth investors expect. You do not need to calculate a perfect value, but you should ask, what expectations are already included in this price? If everyone expects perfect results, even a good company could fall when its results are merely average. Step 5. Diversify your risk. Putting all your money into one stock can create enormous risk. If that company has a major problem, your entire portfolio can suffer. A diversified fund can spread exposure across many companies, sectors, or countries. Diversification cannot prevent losses, but it can reduce the impact of one investment performing badly. Step 6. Stop trying to find the perfect day. Nobody knows with certainty whether the market will be higher or lower next week. Instead of waiting for a perfect entry, some investors use regular contributions or buy-in stages. This can reduce the pressure of trying to predict one exact moment. That does not guarantee a better return. It simply creates a process that may be easier to follow than reacting to every headline. Step 7. Know what could go wrong. Before buying, write down the main risks. Could sales decline? Could competition increase? Could debt become a problem? Could new regulations affect the company? Could the stock already be priced for unrealistic growth? If you cannot name a realistic way the investment could fail, you may be focusing only on the positive story. The final checklist. Before buying a stock, ask, do I understand the business? Does the price make sense? Can I hold through a major decline? Is this position too large? What would make me sell? If you do not know the answers, waiting and researching is a decision too. The best investment is not always the stock that looks most exciting. It may be the investment you understand well enough to hold when the market becomes uncomfortable. The market does not reward confidence by itself. It rewards preparation, discipline, and risk awareness. So, should you buy a stock right now? Do not ask only, will the price go up? Ask, does this investment fit my goal, my time horizon, and my ability to handle risk? If the answer is yes, create a plan. If the answer is no, keep learning and wait. This video is for educational purposes only, not financial advice. Investments involve risk, and you can lose money. Past performance does not guarantee future results.